Hello and welcome to Livewire's The Pitch. I'm Ali Selby and today we'll be learning all about momentum, following the herd and whether or not it's worth being contrarian in today's markets. To do that, we're joined by State Street Global Advisors Bruce Apted. Thank you so much for joining us today, Bruce.
Thanks, Ali. Lovely to be here.
Let's start with the big picture.
Yeah.
Where are we in the cycle?
Yeah, so I think when most people ask that question, they think about the economic cycle, and clearly there is an economic cycle. So just in terms of that one, I think it's probably pretty well established by most people would accept that. We've gone through the growth phase, we've had the inflation, now we've had the rate rises, and we're sort of towards that, the slowing down that comes after those rate rises. So towards the end of that classic economic cycle. And that presents certain opportunities and challenges in terms of how you invest and how you might move things around. So traditionally what we see is that when after interest rates have peaked, we find that actually that's a great time to be involved in sort of lower volatility strategies. And some of the high volatility strategies tend to have a tougher time just after rate cycles peak. So the jury's still out on that one, of course, but there's certainly been some market expectations that rates could come down. So that's one side. The other side that I think probably gets missed quite a bit by people too is around styles of investing. So there's a cycle in those as well. And if you think about, when I reflect on my career and my history and things I've seen, there's obviously been some pretty big cycles around value and growth. So we saw in the 2000 dot-com period, that was when growth had amazing returns and value managers were having a terrible time and they were shutting their doors out of persistent underperformance. We got a GFC type event and we saw other styles have really good runs after that period. So once again, after the GFC, when we got very close to zero to low interest rates globally, that was an impetus for growth to really do really well. And we saw a prolonged period of growth doing well from really 2008 through to about 2020. It was a very long period where growth outperformed value. And then equally with something like low volatility versus high volatility, we look back over 80 years and we see that there's strong returns to low volatility over high volatility, and yet we go through these periods, these prolonged periods, where one will outperform for quite a while and then the other will, and we rotate back and forth between those. So just to give you the context on the low vol one, so low vol really post GFC was a beneficiary of that. So from 2008 through to basically about mid 2016, low volatility strategies globally did pretty well. And then from 2016, they've had a much tougher time where we've seen quite a few bouts of high volatility stocks outperforming. So there's a couple of other cycles just to think about there. When you're thinking about long-term investing, positioning yourself, versus that, against that long-term trend.
Okay, that was a little bit of the past. Let's think about the future.
Okay.
We've seen investors rotate away from defences into higher beta, lower profitability and higher growth stocks. Is that momentum sustainable in your view?
Yeah, so I think it's always got to be based on the fundamentals in these businesses, right? So if there's growth and it's justified and it's high quality growth, then those things can maintain their valuations. The part of the market that we feel least comfortable maintaining its momentum is in those lower quality types of businesses, the ones that really haven't got the underlying earnings and the cash flow to support them coming through, and they're typically the ones that will have these flashes in the pan where people will get excited about the concept or the interest behind the business, but it won't be sustainable unless you do really see those fundamentals come through over time with it. So yeah, there's certainly some pockets of the market that we look at and think that they're a little bit speculative at the moment, but equally there are some parts, AI is the big theme, right, that everyone's talking about, and it's fascinating. And there's real economic fundamentals behind that is genuinely improving the prospects for many businesses. So you do have to kind of sort the weed out there from the chaff and focus on the ones that have got the fundamentals versus the ones that don't, and then you can sort of make more informed decisions.
Yeah, speaking of AI, we've definitely seen a lot of investors crowd into those AI beneficiaries. Yeah. Is there any danger in following the herd?
Yeah, so once again, it's all about if there's fundamentals behind it, it's fine. And so I think if you're just trading on, there's a strategy out there known as momentum, and essentially it's buying things because they're going up. To me, and it actually surprisingly works better than you might expect it to work. There's persistent periods of time where that strategy actually can generate positive excess returns. But it's an incredibly one-dimensional way of looking at stocks, and it is inherently very risky. So for us, the lens we'd always approach is understand that there's sentiment in the market, understand there's momentum, things happening, and particular pockets of the market that are very loved by the market and have these momentum characteristics. But look at it through the lens of valuation, look at it through the lens of quality as well, and then you can get a much better picture as to whether that's how justified that price momentum actually is.
How much value are you seeing in the market today, or where are you seeing value right now?
Yeah, so I suppose that you can look at that across so many different levels, I suppose, but from a style perspective, we're seeing value in some of the low beta stocks, the ones that have been out of favour. We're also seeing, and then if we kind of look at our full quantitative approach of assessing stocks and we aggregate that up, we can see pockets of value across things like healthcare and staples, which have been marked down. They're part of that same low vol story. And there's been all sorts of different elements of disruption in those businesses. And then I suppose if we actually think about another style that has been doing really well, it's been like the quiet achiever over the last few years, and that's quality. So businesses that have very good operating returns, they've got good structures around their debt, and they've got good metrics financially, but also they've got other less financial elements around quality that are important as well. Those businesses have been doing well over the last couple of years, and I think on a forward-looking environment they should continue to do well because they're just more robust businesses and they can handle disruption more easily than some other businesses.
Okay, well thank you so much for your time today, Bruce. It was awesome to have you on the pitch.
Thanks, Ali. Great to be here.
If you enjoyed that too, don't forget to subscribe to Livewire's YouTube channel. We've got so much great content coming every single week.